Okay, so, all right, so we'll be ready to call roll call. I think we're now just at a.
I'm here, Carolyn. It's Jack.
Hi, Jack.
There too.
Oh, what? Hey, Russell, great. Yeah, okay, so I think we just reached the quorum. We can get going. All right, guys. All right, I'm gonna call the meeting to order. Thanks, everyone. Thanks for your patience with this. I'm gonna call the JRIB meeting to order here on January 24th, 7:24 p.m. Gabrielle, would you kindly do a roll call?
Yes. We have Chris, Chief Caliber, Gabrielle, Tom, Carolyn, Selectman Gerber, Eric, Caitlin, Attorney Pierce.
Becker.
Oh, Becker, I'm sorry.
Sorry.
I don't think I've ever met you.
Yeah, I don't think
Nice to meet you.
I meet you.
Hi, how are you? Walter Burke. This is Jack, okay.
Yeah.
Russ Brand, Jack, Kevin, Jim Brown, and I just need caller one identified.
It's Russ. It's Russ, I got Russ over here.
Caller one, you're muted.
Just somebody watching.
There's someone underneath the display box. Is Jack, okay.
Yeah, it's Jack.
Can caller one hear us?
You're unmuted now. You're unmuted.
Are you public or are you a board member?
Is it Bruce? Could it be Bruce Ryan? Who's gonna try to connect?
Possibly maybe type it in the chat? Phone a friend, I'm not sure.
Hi there. Hi there. I don't know who caller one is.
Who's usually joining us? Oh, who's that? That might be Brian.
Yeah, I'm here, Brian, but should be on video.
Okay.
Um,
And hi there. Hi there. Okay, and we have Barclay Douglas with us as well from Criterion. All right, thank you. All right, guys.
Caller one, oh good, they're muted.
Unmuted.
All right, everyone, welcome. Thanks. And Benyani is with us as well. All right. I think that was Bruce. Bruce Ryan just texted. He is indeed caller one,
Okay.
or mystery caller one. Where would we be without text?
He's on his phone.
There we go. Hi there. Hi there. All right. Hi, Bruce. Great, everyone. Thanks for coming this evening. All right. Let's. We've got a fun evening. And I appreciate everyone's being here. So let's kind of get right into it. Item number 2. We have a motion. We're going to hear, consider, and approve the minutes of December 6, 2023, the regular meeting. That was the annual meeting where we approve officers. Everyone, very, very quickly. If you haven't taken a look, take a look. If not, if you make a motion, please.
Motion to approve.
Okay, you have a second? Second from First Selectman Gerber. All in favor, say aye.
Hi,
Any
I'm
opposed?
gonna abstain, Carolyn.
Thank you. Ken Brockfield abstains.
Abstains.
Eric Caliber abstains. Any other abstention? Okay, so noted. Thank you. All right, let's move on to point number 3. Item number 3, the OCIO transition. First off, I'd like to give you an update from the subcommittee, just on the status and the timing of the transition. So first off, I want to thank the subcommittee who went to work very, very quickly. That's Tom, Eric, Ken, and myself. We kind of, we were formed right on that December 6th meeting. We worked very closely, and we should thank Brian Binkley, who's with us here from Vanguard. I think at our meeting, that last JRIB meeting, we kind of expressed our concerns in the meeting. Our concerns were mainly about timing of the transition, about our concern about being able to have investment in those and a search consultant and having help with the fees on the search consultant fees. And then our very real concern about the fees for our HarborVest investments. And I'm delighted to share with you that it was about 2 weeks ago that Vanguard shared with us that HarborVest has agreed to hold our fees flat at their original level for the life of our investment in those 3 vintages. And they've also agreed to take on kind of the administration and the servicing of our account for the life of our investment as well. So we're thrilled about that. That was an easy ask. That was a very difficult kind of intense and fraught negotiation. And it's one that Vanguard really went to bat for us on. So we, Brian, and how he's on that.
It was the right thing to do, so I'm glad it all worked out.
Yeah.
Okay, will the reporting be separate from that? Is there, or would the OCIO still be responsible for pulling that into the monthly?
That remains to be seen. That's what we're going to talk about with Berkeley. So the search committee moved very quickly. If you recall, Vanguard provided us a list of maybe 25, 30 OCIO search consultants. We were able to double check them with our friends, how he's fund, who we know locally. We got that narrowed down to a list of 6. We then further whittled that down to a group of 3. I spent an hour on the phone with 3. Those 3 met with the subcommittee. The subcommittee then chose 1. We felt was the best fit, and that 1, Barclay Douglas, will be presenting with us to us in just a few minutes, and he's with a firm called Criterion, and he'll walk through kind of how he sees the landscape and what kind of how he kind of the service that he can provide and the timing. And I think you'll see that we can get this done. Regarding the timing, that's the last piece on the subcommittee kind of update. I think the original guess was, we'd have to transition very quickly. Vanguard has been very kind too and gracious, and they've extended their thinking on that they'll be able to service us. They've given us their word for 90 days post transition close. I don't think we'll need that full time, but it's very nice to have that full time, to know that, that they view us very much as a co-fiduciary and we're not going to be dropped.
Yeah,
Right.
yeah, and I have no update like as far as the close, but as soon as I hear anything, I'll of course share it.
Okay, Speedy. That's where we stand. That's where we stand. Also, I think you'll kind of expect to go forward from here. What lays ahead for us is the search committee will continue to kind of run point on this, on working with Criterion should, once we vote on it and we we vote on the contract, we'll work on making sure that we have Speedy wants to look at what the RFP details will look like, what we think is the right approach for this board, how broad a search we go out for, how quickly we come back in, and how the role of the search committee, how many finalists, how many semifinalists we want to bring in, and how many finalists we'll want to bring to JRIB, with the target of having the finalists brought before the JRIB in the April meeting. Speedy. This is very, very speedy. This is a very accelerated time.
So it took us almost a year.
Almost a year. Yeah, we're gonna do this really fast. Yeah, no moss is gonna grow under his shoes. Not that we are going, Walter. We are going. And that was the primary consideration with our selection of a search consultant, was who could work with us in a very agile, flexible way.
Excellent job.
And who had the true knowledge, who really had deep knowledge of all of the capable OCIO options out there. So please, to my wonderful committee, did I miss anything? Is there anything, please, can we add? Eric,
No.
add?
Yeah, no, covered.
No, I think that covers it well. I would just say that, this is Ken. I think Carolyn did a genuinely excellent job narrowing it down to 3 candidates that we, I think, pretty thoroughly interviewed and investigated. And I don't want to jump the gun. I want Barclay to make a presentation to the board, but I felt he was a terrific choice.
Thanks. Thanks. All right, so without further ado, I would like to please, if you might, I'd like to introduce Barclay Adelius from Criterium, and thank you, Barclay, for sorry for the technical mishaps here this evening. Thanks for bearing with us. But welcome to Fairfield and to the to JRIB.
I realize I could be on a 4-hour train back and forth, so the technicalities don't bother me at all. If you're ready for me to go, Carolyn, I'm game.
Please do.
Well, it's a pleasure to be here. Thank you very much. I've got a 20-page presentation. Carolyn, can you put it up on the screen?
Can I put it up on screen?
Be able to share it. Can he share? You can share his screen.
I don't know if I can, because of the way that we're now set up right now. Who can do this?
I need to get it to this computer so I can share it from here.
Let me-
But he should be able to share it from his computer.
Let me see if I can do something here.
Quite terrifying.
We're not gonna mess with the WebEx. Let me see if I can do it. This is one of those kind of days. Let's see what I can do.
Yeah.
Should email on that computer.
Yeah, if we could email it to us here too. Or email it to somewhere here.
All right, I'm working on it. Yeah, I'm gonna pull it up on the email, off the email.
Yeah, just grab the browser and
Yeah, it was one I was trying to open up.
there you go. Just go ahead and do tab.
Are you guys pulling it up?
Try.
Okay.
This isn't, I can go over this, right?
Yeah, you're good. You're two separate things. Just did a got it there.
Just take got it out of your way.
I'll just start the introduction.
Years I left.
Berkeley, would you like to just kind of begin with a quick, kind of a your background a little bit as we keep as we pull it up?
Sure. I've been in the industry a long time. I started as a broker and got very lucky and had some clients that were incredibly good mentors. One of them was the investment committee at Grinnell College that was chaired. Years I left, had Arthur Rock in it. Another was the Weyerhaeuser family. So I got lucky and I wanted to get into real investing. And I went to a firm called DeMarch Associates, a consultant. I was there 8 years. I decided I wanted to make a little bit more money, which you get in the asset management world. And I went to Delaware Investment Advisors. My third year there, I was named CEO of their institutional business. We had about 50 billion under management. And after 8 years, I left and took the position of CEO with Baring Asset Management, global firm offices in Boston, Hong Kong, London, Tokyo. And that's what moved me to Boston. That's what got me to New England. I had been a Midwesterner. I was there for 8 years as well, negotiated the sale of the firm to MassMutual, took a year off, and then figured out that I wanted to get back into consulting. And I opened an extremely small firm of the OCIO with investment committees, sometimes just as an advisor and sometimes doing OCIO search. So I've been doing this since 2013. Good. Thanks very much for that. We've got it here, and I'm going to be asking you to turn pages fairly quickly. We've got 20 pages. It's okay. I've got 20 minutes to present, but that's because it's about 80 to 85% reference for you. This is a presentation which gives you a very broad understanding of the OCIO industry. I have 3 pages which are specific to Fairfield, town of Fairfield. So let's go back to that first one, not the cover, but yeah, right there. The only thing here is on the left-hand side, I list 7 different governance structures. You are number 5 and will continue to be number 5. The right-hand side of the page is really interesting to me because if you want to ask a question, so those are the questions that will really have an impact. It's this one. The question is, if you're trying to outperform the benchmark, which investment levers will you try to pull? And I identify 5 there. Will you have asset allocation different than the norm, which by the way you do? How will you implement the individual asset classes? Is it the active security selection? Is it active tactical allocation? Or can you do a good job at fee negotiation? So those are the questions that you would be asking most OCIOs if you were hiring somebody that was attempting to outperform the benchmark. Let's go to the next page. Okay, this is pure reference. This is a challenging business. It's kind of what I spent my life doing. And I list 6 reasons why, and not all of them, but reasons why it's challenging. And I'll just point to 2. You can look at the other one down. Investing is a social science. At times, foolish or bad strategies do very well, and vice versa, good strategies underperform. This makes intuitive assessment very hard to do. And then I'll go down to point 4, which is something your group has clearly embraced. Investing is unusual because the cost and the benefit is denominated in the exact same thing, dollars. I'll say lay one down. You know, you might think you're buying a Ferrari, but because the cost is so high, you're actually getting a Yugo. Let's go to the next page. I am a massive believer that investing should be philosophically driven. I also love quotes, and I list 5 here that are among my favorite. Arrogantly, the last one is mine, but the only one I want to touch on here. Yeah, the only one I want to touch on here is the one from David Swenson. It's the 4th one down. Casual acceptance invites casual reversal. What he means there is you need to embrace, understand, embrace, and be loyal to the strategy you've picked, because there's no question they will underperform at times. And you can't be latching onto something just because it feels good or it's performed well recently, because you're bound to reverse course when it runs into trouble. For example, a strategy like you've had and done very well with, I have asked over, if you looked at the 10-year numbers ending 2008, you would have been up 2 on an annualized basis per year. So this is what I mean about loyalty to a strategy. Let's go to the next page. Now this one is specific to the town of Fairfield. I don't know how complex this project will be. When I do one-on-one calls with key people, I'll be asking questions and we'll uncover which of I have asked over sets you have. The first one, we may be simply trying to find an OCIO that can map exactly what we have with Vanguard and be completely passive with the real estate and the private equity. We may decide that we want to look at some OCIO candidates who are a little bit more active. We may decide that we want to look at candidates that could do either one, pure passive, and I have asked over, I want to migrate into more active strategies. And number 4, the subcommittee is already ruled out. We're not going to be highly active, which would translate to very high fees. So these are the 3 different mindsets that will dictate how we approach this and which type of candidates we look at. Let's move to the next page. These are ideas that have come to me from very smart CIOs that I've known over the years. I have asked over, and I think they apply to you. First, every investment approach can work for short periods of time. You could throw darts, and that could work for very short periods of time. Over a medium to long term, big mistakes can be made. You can pay too much in fees. You can use inferior quality alternatives. The committee can have a short time horizon and change too much, which is very costly. But there are a handful of strategies that work. I have asked over 100 CIOs what the role of a CIO is. Literally half of them didn't know. They couldn't come up with an answer. 25% came up with an extremely varied answer. And another 25% came up with this one, which I think is right. The goal of a CIO or an OCIO is to select the approach that has the highest probability of success. What that means is that approach will rarely, if ever, be top decile or bottom decile. Work with going to be making enormous bets and having outlier performance. I do think that there are 4 or 5 strategies that can work. It's just crucial to understand the ramifications for each of those strategies, where they can fall short and when they can outperform, which is primarily an environmentally driven issue. Let's go forward. This is a page I use a lot because every committee that I work with has to decide on some policy issues. I list 6 here. There are more, but these 6 are ones that we use with everybody. How active versus passive do you want to be, and in which categories? Asset allocation. You want to be purely policy-based, which Vanguard is, or do you want to do some tactical allocation? The third, most of you have heard of the endowment model. It means more active management, heavy use of alt, or is it some level of tactical? Where do you want to be on that traditional versus endowment model scale? Fourth, home country bias. We want to have a home country bias, which you do, and I actually like it very much. I think it's a very healthy allocation. Fifth, you want to integrate ESG, DEI, or impact strategies into your portfolio. And the sixth one, we talk about risk. I mean, I've got that's about 600 pages titled Investment Risk. To me, it's simpler than that. There's really 4 things to think about. Do we want to, how much liquidity do we need? Is there an illiquidity risk issue? Secondly, are we taking enough risk to generate the long-term returns that we're seeking? And then the last 2 are kind of a heads and tails. One is our primary definition of risk the probability of a permanent loss of capital? Or is it a relative risk, the probability of underperforming the benchmark or our peers? And those issues keep coming up. Even Harvard got that wrong. This last part of the page, I talk about management intensity, and there's a continuum. Right now, you're in A with an interesting allocation to private equity and private real estate. You may want to move a little bit further left, but I know you're not going to get into the 7, 8, 9, 10. So that's understood. And then the 2 caveats, cost matters. As Vanguard would be clear to tell you, sometimes you think you're buying the best, but you're paying too much. And because they're denominated in the same thing, you've got a Yugo. The other thing on the endowment model, it requires incredible skill and access to the best managers. If you do alternatives in a mediocre way, it's going to be suboptimal. It'll be worse than not doing them at all. Next page. This next page is just a very quick overview of what the portfolio structures from the traditional versus the endowment model look like. You'll see on the endowment model, it's much more granular, using much more alternatives. The traditional model is pretty darn close to where you guys are right now. You don't break credit out, which I might do, but it's very similar to where you are. Category. Now I'm going to start talking about how our OCIO is different. And to me, there's 4 categories of variables that differentiate those firms. The simple one is the organizational type. Next one is the delivery model. Third is the most important to me. We're not going to spend any time on it today. It's something we'll dig into later, but it has to do with the driving philosophy behind the OCIO. And then I've got some catch-all factors that I'll category. Again, I want to confirm this mainly is reference for you, so you understand the landscape of the OCIO industry. We may be having a much simpler approach depending on what you decide on those paths. Let's go to the next page and I'll touch on the 4 different organizational types that have OCIOs. Consulting firms, we're probably not going to look at any consultants. Fund-to-fund providers, I'm not sure if Vanguard fits in that category or the large money manager strategies, but fund-to-fund providers are SEI, Northern Trust, Russell, and so on. The large multi-strategy money managers, Goldman Sachs, JP Morgan, Morgan Stanley, and then specialized OCIO boutiques, which we're probably not going to look at very many of those either, because they tend to be much more aggressive and more actively management oriented. Let's go to the next one, which has to do with the delivery model. And the goal was on point one. When you look at OCIOs, and I'm touching on it because it's the most important, there are really three different delivery models. One is a fully customized approach where you retain each of the managers that you're hiring. The second is a building block approach where the OCIO has a commingled fund for every major asset class. It could be 5, it could be 6. And your goal was build fund, which has the benefit of every client is getting the same fund. And the last one is the one-stop approach, which is quite common, but it's not something we're going to look at. It's the kind of OCI who says all of our clients want the same thing. If you invest with us, you're going to get the same portfolio as every other client. There are other examples of delivery models. Do they manage money themselves, or is it all external managers? And then I'm going to touch on fee. Goal was, which are dramatic in the OCIO world, which you probably saw in your last search process. Let's go to the next page. Yeah, differences in the approach. I'm not going to touch on this, but there's 15 different points. It would take too long to go through, but I'd love it if you would look at them individually, because I worked with Jack Meyer, who used to be the CIO at Harvard, and our goal was to figure out what are the key philosophical differences between CIOs and OCIOs, and we came up with these 15, which might be interesting for you to understand. Let's go 2 more pages. These are the catch-all factors, and I list 7 here. Some of them may be interesting. I'm only going to touch on the first 2. True access to desirable managers. Everybody says they have it, not for $400 million. True ability to negotiate fees. I wish we weren't leaving Vanguard here, because they are the #1 firm in the industry at beating down managers on their fees. So those are, other things that differentiate OCIOs. Let's go to the next slide. And, let's keep going. I just wanted to give you a sense for the fee differentials. And, I've done a survey for a $400 million defined benefit plan. The fees could range from a low of, this is the OCIO fee, a low of 3 basis points, which is your fee right now, to a high of 100 basis points plus a performance fee. Dramatic differences. The all-in fee, which is the OCIO fee plus the underlying manager's fees, those can range from 17 to 224 basis points. Or the homogeneity, looking at an all-in fee of somewhere between 20 and somewhere between 55. That's probably the range that we're going to be looking at. Let's go to the next page. Performance, I just bring this up because when you look at composite performance of OCIOs, this is still in the Stone Age. There's different ways to do it. You can't rely on the accuracy or the homogeneity of performance comparisons, which is why I'm a little bit more qualitative. Yes, I will certainly know when an OCIO has had some time bombs in their track record and make you aware of that. But the differences, the diversity in how they show performance, it's just not an apples to apples business. Brian can probably relate to that for me. Let's go to the next one. So, and then let's go to the next 2 pages of selection criteria. When I begin with a client, I want to understand what our key criteria are right out of the box. So I list 12 or so potential, and I ask us to figure out which ones we are emphasizing. I'll only cover the ones that are in bold. The first one is, does the investment flexibility that manager provides accommodate what our investment committee and our fund needs? And then let's go to the next page. There's 2 or 3 more that I want to touch on because these are kind of unique. One, firm health, perceived longevity, and continuity of recognized professionals. Well, who would have known that when you hired Vanguard, they were not going to be a standalone entity like they had been. So perceived longevity has to do with M&A. It has to do with survivability of the firm and so on. That'll be a key criteria. Are the investment beliefs of the OCIO, to the question of our committee? And the last one is I would consider unrecognized for most of our industry. It has to do with the divergence factor, which if you're in the industry, it means tracking error. Are we running a strategy that has a high probability of differentiating in a meaningful way from benchmark and peers, or is it fairly tight? Obviously, at this point, you've adopted for extremely low divergence. I've seen the updated to the question, you're almost right on top of the benchmarks, with the exception of the private equity numbers. So again, those are some selection criteria we'll consider. Let's go to the next slide. I've surveyed at this point, about 70 funds that use an OCIO. They're over 50 million and they have used them for at least 2 years. I asked them 4 or 5 questions, and the most interesting question and responses I got were to the question, what have been the negative surprises? One, the all-in cost was too high. I mean, you see the list here. The ones in bold are the ones that I think are the most relevant. But you know, the all-in cost higher than expected. There are some funds that have an all-in cost of around 180 basis points, and the OCIO is targeting a 50 basis point excess return. Now, that math just up your sub, because the 180 basis points is fixed and the 50 basis points is aspirational. So that gets back to the Ferrari and the Yugo comment. Let's go to the next page, which may be the last. Yes, probably the most important for you. These are the proposed steps in the process. Today's meeting, going over this landscape and meeting and answering questions for you all. Next, your subcommittee has agreed that a one-on-one call with select fiduciaries, probably 6 or 7 would be good. I've got a survey list of about 15 questions that we'll go through. A lot of it has to do with investment beliefs, investment philosophy. That will shape the type of firm that we want to look for. Our first meeting, tentatively scheduled for February 7th, we'll review what I learned from the one-on-one calls, where we have views and kind of thing, where there's disparity. We'll also reach conclusions on, are we simply looking to map Vanguard's approach, or are we looking for some OCIOs that are a little bit more active? We'll make a decision on how deep we want to get into in the RFP. Do we want to, I mean, some of these RFPs look like the California State phone book, incredibly large. The RFP isn't as important as most kind of thing, I believe, at the beginning. And the reason is they're incredibly hard to read, but more importantly, some very mediocre OCIOs write fabulous RFPs and vice versa. Some of the best OCIOs aren't very marketing savvy. So I think you're going to get the most information out of the 3 to 4 page profiles that I write, which are written very objectively, along with comparative tables. How many people on the investment team? What's your asset size? That kind of thing. At that meeting, we'll also discuss selection criteria. I will have at that meeting 2 sets of OCIO candidates. One, if we want to stay predominantly passive. A second, if we want to look at passive and managers that have some level of activity. And so we'll go through those. I will also ask your group if they have any firms that they would like to add to that list. And then I will begin gather information to prepare profiles on those candidates. We may send out a lengthy RFP. My hope is that we send out a fairly brief RFP. I have fresh RFPs, and by that I mean they're 4 months old on most of these candidates anyway. Meeting 2, which is scheduled for April 10th, we'll review and contrast the candidates with the goal of selecting finalists, and I'm hoping that it's somewhere between 2 and 4. We will also review and confirm the selection criteria that we'll use in those meetings. And then on the 24th of that month, we'll have in-person finalist presentations. So we're able to do this fairly expeditiously. Once we've made a selection, the final activities are fairly diligent. We'll work on the contract, which sometimes is more onerous than I would like, but we'll get that in place. We'll coordinate the transition, what the time in that, and what the accountabilities are, which will include the new OCIO, our own staff, and Vanguard. Do the final fee negotiation, which sometimes at the end, it's possible to even make the fees more attractive. We'll request a written, what I call prenup, which simply means if we were to terminate you, what are the liquidity issues and what are the ongoing fee issues, which we hope liquidity is quick than that and ongoing fees, but that's not the case with all OCIOs. Second to last thing is I will work with the OCIO and your subcommittee to redraft the investment policy statement. It won't be a major change, probably, but we do need to redraft it because they will likely use different terminology, different categories for asset classes and so on than Vanguard has. And who knows, we may end up being a little bit more active, which would lengthen that. And then the last thing, I will draft what I call the investment constitution. Investment policy statements bug me a little bit because they're so full of legalese and cliches. I was going through one about 2 months ago where the word fiduciary was used over 20 times. The investment constitution is something that is written very informally in plain English that describes the driving investment beliefs behind our strategy.
I noticed that
Why we selected the OCIO that we selected, what were the reasons, and C, how we plan to assess them pretty clearly. This turns out to be a good document for you to give to the board. It turns out to be a very good document for new committee members coming on board. And frankly, it's rare that an investment committee actually aggregates their views. So I hope I've made it within relatively close to the time and open it up for questions.
I noticed that
So the timeline that's up, guys, that April 24th meeting is a regularly scheduled JRIB meeting. That April 10th and the February 7th meetings would be probably held subcommittee meetings, but we would have special meetings for those. So with that, any questions for Barclay?
Thank you, Barclay, for that. I had a quick question. This is Tom Collmore for what it's worth. I noticed that you said historical performance is a criterion for evaluating an OCIO, but that separately, I saw that only 30% of OCIOs are GIPS compliant. How do you reconcile those two?
Well, GIPS compliance is it's a very tough thing to do, actually. There are a handful of OCIOs that are not GIPS compliant, but I know that their performance is completely valid because I have GIPS compliant because it's a very onerous thing to do. And frankly, when you're GIPS compliant, there are things that the OCIOs didn't realize that they would have to do. For example, if you're going to include your legacy private equity assets and give it to a new OCIO, they cannot include those numbers in their composite or your performance. That is GIPS compliant. So there's a number of regulations that makes it a little bit tougher. But I do have a very firm handle because I have clients with or have reviewed most of the OCIOs with their clients. So I have a very firm handle on which ones are giving an accurate story and which ones are fudging a little bit. For example, there are some OCIOs that might have 100 clients, but their composite only has 30 of those clients. They're using some selected memory. There's another 4 or 5 OCIOs out there who are only using one representative client. And there may be very large disparities.
What he was saying before, I
I
mean,
don't know if I'm answering your question, but the bottom line is that GIPS compliant does not assure accuracy in the OCIO world. If I was hiring a large cap growth manager, absolutely, they got to be GIPS compliant. But in the OCIO world, all clients are different. So it's very hard to be representative.
Thank you.
what he was saying before, I mean,
Brian, you can feel free to jump in and disagree anytime you want.
No, there's a lot there. It was a good overview, but happy if there's any questions from the committee or you want me to weigh in anywhere, let me know.
I mean, based on what he was saying before, I mean, did we kind of get the perfect guy in Vanguard in the time that we got them? Because it looks like we're never going to replicate the kind of fee structure that we got.
We did really well.
then.
We did really, really well.
I mean, it just seems like, you know,
Yeah.
so basically from what you were saying, you know, to get that fee structure is going to be almost impossible again.
Well, no, we can come very close to that if in fact you want to be 100% passive. You know, we'd look at State Street, we'd look at PFM. Those firms are all trying to be competitive with Vanguard. So, you know, we can come very close to that if in fact you wish to just map the entire public equity, public fixed income on a passive basis.
Are we going to,
Not
I
to-
mean, again, it's been so long ago.
Yeah, so that's the question. So what, one of the first step in Barclays, as he had in his presentation, and is he would want to speak with 8 or so of us individually, schedule separate calls, 30-minute phone calls. And Barclay, perhaps you can explain that part of the process that you would do.
I've been able to do it with almost every OCIO search client. I have the chair of the committee select fiduciaries that they think this would be representative. And we go through 15 or so questions to get an idea of your underlying beliefs. It works better one-on-one. Some of you may agree with me that some of the wisest minds tend to be quiet, and sometimes vice versa. Some of the less experienced tend to be quite vocal. I love to get one-on-one because I get a real strong understanding of what each individual believes. And then I come back to you with, these are ideas we have in common, and here's some areas where we have differences of opinion.
And Chris, just for
The bottom line
context,
is, go ahead.
go ahead, Barclay, finish.
Well, I mean, the bottom line is this will help shape the OCIO firms that we look at.
All I was going to add for context for Chris and the JRIB, and I can't speak for other OCIOs, but you know, of course, we implemented passive with all the public investments, but our fee would not have been different if we implemented some active equity or active fixed income. It wouldn't have changed our OCIO fee. Maybe that's different for others, I don't know, but I just wanted to give the JRIB some context.
Now, again, when I'm looking at fees, I look at 2 components. One is the OCIO fee, and the second is the underlying manager's fees.
Right.
Now, if you had used some of Vanguard's active funds, which by the way, they get incredibly low fees on active managers, your all-in fee, the combination would have gone up, but their OCIO fee would not.
Brian's got a nice slide too in his deck that has all the fees. broken
Fees,
down.
yeah, that we'll talk about.
Helpful.
Are there any other questions?
Just,
Yeah.
so you did a lot of work a couple years ago and you determined the passive approach is the way you wanted to go.
Hey, Ken, are you with us?
I'm just curious, this is a rethinking?
Yes, I don't know if Ken, here's
Ken is here. Ken is here.
Ken
we're
is
there.
here. Ken, would
We
you like,
definitely heard that.
would you like to take us back in time quickly as to the thinking of taking us a kind of the transition away from the consultant model to the OCIO model and the thinking of moving to the passive strategies? For
Well, I know why you got
Well-
away from the consultant model.
Yeah.
Um,
Yeah, I mean, I don't think there's anything too mysterious about it. I think we, as a group, I think we should just remember always that we are a well-meaning group of volunteers with a varying set of skills and interests. And, the evidence is overwhelming, and I don't want to speak for Barclay or Brian, but it's pretty overwhelming that in a majority of the markets, a majority of the sectors, chasing outperformance or alpha, as it's known on Wall Street, is a fool's game. 90 or more % of active funds underperform their indexes in most of the sectors, not all, most. And we just felt, if I remember correctly, that's been a few years, that we should focus our energies where we thought we could add some value. So we went to the passive, lowest cost possible strategy for a healthy chunk of our portfolio, and then took on some areas where we thought we could, get a little bit of spice or excitement, such as in private equity, and added that in, and in fact got absolutely fantastic pricing from Vanguard on some of those other items, and more power to Carolyn for putting the hammer down on HarborVest to get them to continue to offer us that pricing and to do the record keeping for us. So for me, I'm going to be very happy to speak to Barclay, assuming we approve him this evening. But I basically described my investment philosophy in a couple of paragraphs here. And I think that's where the board was a couple of years ago when we selected Vanguard.
It was a lot of work too. I mean, we had to keep on top of a lot of stuff, and it was
It was a lot of
it
work.
burned us out. I mean, I think of that,
Precisely. And again, I don't think any of us are averse to doing quote unquote work where there might be a payoff. But, just to, for an example, large cap stocks, stocks that are correlated somewhat to the S&P 500, there's simply no way to, if 1 out of 10 managers outperform, and I'm not even sure 1 out of 10 do, there's simply no way prospectively that you can, select that manager or those managers. So we chose to minimize the work that we wanted to do where we didn't think that work would be valuable. I hope that makes some sense.
And the decision made a lot of, and it worked. And the allocation decisions really worked.
It sure did. I mean, I haven't been on the board for a few years, but the results have been absolutely excellent.
Yes, but any moment for, this is also an opportunity for us to do, this is a diligence opportunity too for us, right? To take a moment to think, is this the right strategy? Do we continue with it or not? And I think that's part of the exercise. We're not going to take a long dwell on it. I don't think we don't have the time for that. But to be able to kind of reflect and think proactively too about, what's the right move from here. I think that's what Barclay, if we vote as we approve him this evening, he'll guide us through.
I have a feeling that the reason it took a long time, the last time you did this OCIO search, is that you were in a very much an educational mode. We plan to expedite that by right up front figuring out what type of OCIO you want to look at, which will make the path a lot clearer.
Well, all right. Well, are we okay to? We have enough information. Could I ask for a comfortable asking for a motion?
This is Ken. I'd be very, very confident and pleased to make a motion that we select and hire Barclay to lead our search.
Thank you, Ken. Tom, you'll second?
Sure.
Okay. All in favor?
Aye.
Do you have any opposed? Any abstain? Terrific. Thank you. Barclay, thank you. I will call you tomorrow. I will deliver to you a list of names to do the one-on-one calls with. And I'll have that for you. And I really do appreciate your willingness to be part of this process and help guide us through.
I'm honored and look forward to it. Thank you very much.
Thanks a lot.
meeting you. Good luck.
You as well. Take care.
All right. Thank you, guys. All right.
No, thanks to the group. I mean, I think you guys did a great job picking him out. He seems like I like his approach, and I'm looking forward.
He's, you know, he's very good, very, very sophisticated.
He was
And
good on that call.
Yeah.
He was good on the call when you had the other two on there, that subcommittee call.
yeah, yeah.
Also, something that he mentioned when we were in the, I guess you call it the waiting room here while you guys were getting your WebEx going. He doesn't do like tons and tons of these searches. He said, I forget, Jim, you were on the phone, right? I think he said he does 4 or 5 of this, Brian, per year?
Yeah.
Of these
Yeah,
searches.
That's what I heard him say, yes.
Yeah, so
4 or
we're
5
really
a year.
getting a personal touch. In my
Yeah,
opinion.
what I was told by our friend over at the other firm, he said, if you can get him, like he doesn't take very many and he's very picky, and if you can get him, you'll be very happy. But he turns most of them away. So I called him and we talked for like an hour and a half, and we just had a really good conversation. Just
I should have, then what did he find appealing about working with us? I guess I should have.
his first question was, effectively it was, how's the board set up? What are you looking to do? How fast are you willing to work? You know, like it was all about I think what he really wants to do is to help drive to an outcome rather than just conduct a process. Right, it's much more of a higher common denominator type individual, right? And I think that's really where, for me, the value add is going to be on the back end, right? Rather, after we've selected, is to get the investment policy statement really spruced up and that constitution and get everything negotiated on the back end. I think that's where he's really gonna provide a ton of help for us.
And all of his fees will be covered? We don't have to.
Indeed. Thank you,
Yeah,
Uncle
yeah.
Vanguard.
Yes, yes. So whether, we could talk about it offline, but whether Fairfield invoices us or he invoices us directly, it's fine.
Okay, yeah, I've asked you that, is how we want to do that, because I know he requires some payment at the beginning and then at the end, and
Right.
so,
Question for Brian.
Yeah.
yes.
Yeah, I
Hey,
think
Brian, I
it'll
have a
help
question. I'm gonna
facilitate it.
put you on the spot a little bit, if you don't mind.
Yeah.
What's your immediate quick response to having, I'm gonna call them parallel documents, so the investment constitution and the investment policy statement in parallel? Do you have any reservations about that? Like it? Any thoughts?
Say it again, Tom, because I don't follow, like having 2 documents in parallel.
Yeah, one is basically a colloquial version of the other. I think the investment constitution, as Barclay put it, is sort of a layman's language statement of philosophy, et cetera, et cetera. Whereas the IPS is a more legalistic, formal
Right.
document. Just wondered, in your experience, are there any issues with having a parallel pair of documents like that, or is it just fine?
I haven't come across whether Vanguard or other firms like, more of the other document. It's always referenced the IPS because that's the legal document. And, I wouldn't imagine that maybe my view is a little bit different. I wouldn't imagine the IPS would have to change all that much because, again, what's in the IPS is at the asset class level is the targets. It's not talking about. So, I mean, if the committee, for whatever reason, changes the asset allocation, it's just changing the numbers to the specific asset classes. So I don't think it should be a big lift updating the IPS. We were going to take on that kind of project as part of our regular ongoing due diligence, just, even before this all happened. But I'm not aware, I haven't seen like another side document.
Thank you.
If I could, here's the name of the list of, if anyone really would like to or doesn't want to talk with Barclay, let me know. But the initial list that I drafted for one-on-one calls was Tom, Eric, Ken, Eric Caliper, Bruce, Brian, Jack Mahoney, who dropped off. It looks like Chris, you'd be interested. That's kind of my initial list. Bill, you're of course welcome to, but I didn't think you would have the time. You've got a lot on your plate right now.
A lot of people here know a lot more than I do.
Right. Walter, I figured you're okay. Russ, Kevin, unless Jim, unless you would really like to, you can let me know. If you feel strongly about that, if you would like, just shoot me a text or let me know and I'll add your name to the list. Okay. All right, perfect. Let's move on. Brian, would you like to walk us through?
Yeah, so I'm gonna pull up my screen. Okay. All right. Is it up?
Yes.
Okay. What happens, which I don't like, is like when I don't know if there's a way to minimize it. When I share, I kind of lose my view of you all. But for terms of this meeting, I was going to review performance kind of, you know, at the calendar year level. I did include, as Chris mentioned, I did include a fee slide to give you some context. And then I also talked about the expected return on assets, which really kind of guides our asset allocation. So everything that we've done is customized. Like I don't have any client that is, you know, because Barclay made reference to customization as you're going through your OCIO search. Everything is customized to the Fairfield. Like we don't have model portfolios, and so we structure this as it relates to your funded status and your discount rate. Those are two things that really come to mind. Why don't I jump into it? But I'll always pause if there's any questions. Please stop me as we go along. And I'll hit this slide at the high level. This is calendar year for 2023. And I focus here because the numbers on this page are representing the broad equity and fixed income indices, which the town, through the pension plan, the OPIP plan, are exposed to. So we have these funds in the portfolio. So as it relates to the market for 2023, a great year, and that was coming off of 2022, which was not so fun. So if we just look here, and this follows your exposure on page 4, U.S. stocks up over 26%. So astounding return. Yes, it was driven by a relatively few large cap tech related names, but nonetheless, that's the benefit of holding the entire market. You don't know what stocks are going to do well, and a lot of times, a lot of the gains do accrue to small number of stocks. So we own the whole haystack through our indexing approach. So we gained 26% in our U.S. equity portfolio. Our non-U.S. equity exposure is 40% of the overall equity. I'll show you that in another slide, but 15.8%. So non-U.S. stocks have continued to lag U.S., but still a healthy gain. And then flipping over to the fixed income side, both U.S. bonds and non-U.S. bonds that we hold, after 2 years of consecutive declines in the fixed income market, with rates finally falling, so U.S. bonds returned 5.6% for the year, and non-U.S. bonds, which we have for the diversification, added 8.7%. I include slide 5 and 6 to kind of just show you, you never know when these rallies are going to happen, and just the importance of staying the course, as Vanguard's late founder Jack Bogle always said. But look, just for U.S. stocks, I mean, look at the big return we got in November and December. It was certainly a volatile year throughout the year, but a lot of the gains came in the fourth quarter. And looking on the right-hand side of page 5, that's very much the case for fixed income, whereas, you know, people started to price in maybe the Fed cutting in 2024. So you had big gains in the fixed income markets as rates fell in November and December. And then for context, what I was just saying, again, the importance of staying the course on page 6. This is showing you a lot of the calendar year returns, but you saw where we were in 2022 for U.S. equities. We're down 19%. So now we've flipped back up to, you know, over 26% in 2023. Look at the bond performance. I've talked to you all about this last year, but 2022 was the worst fixed income return, you know, on history. So that was a really painful when a 60-40 portfolio did not do well, but we had the strong gains in the fixed income market, which I just talked about. And so a 60-40 portfolio, this isn't your portfolio, but again, look at that 2022 return really down, and then that's flipped in 2023. I do have slides, 7, 8, just 9, looking at the sectors of the equity market and fixed income market. Do you want me to skip that, go straight to the town's performance, or you like me to dig into any of that?
Yeah, let's head into the town performance.
Sounds good. So town's performance is here on page 10, if you're following along anywhere. We show both the fiscal year to date and the 1-year return. So as you would imagine from the numbers I just showed you, the last 6 months, absolute return 4.78%, slightly behind the policy benchmark of 5.59, and that carried over to the 1-year return. So the 1-year return, 12.59%, so fantastic return, slightly behind the policy benchmark of 14.7. And that really is all attributed to, as you would imagine, because the index funds are tracking their benchmarks very tightly, it is related to the private side, the private equity and the private real estate, as those kind of values lagged. Like in 2022, those asset classes outperformed the public benchmarks. That's flip-flopped here in 2023. One thing I just want to bring up here on this page is our asset allocation versus our policy targets. And one thing that we should likely update sometime here in 2024 is this private equity policy number. So we show here the policy of 5% and the private equity holdings at 8.49%, but we recognize that our policy target is actually 10%. The reason that we hadn't updated to 10% is because the HarborVest funds were just slowly drawing capital. And if we had a year or so ago put that to 10%, it would have showed us, really underweight some of these other public asset classes. So I think as capital has started to be called for the 2021, the 22, and 2023 HarborVest funds, we should update this private equity target from 5% to 10%.
Does that
I
mean
included.
Does that mean we pull down a target? Does that mean we pull down from somewhere else?
Yes, we would pull down from U.S. equity and non-U.S. equity accordingly. So U.S. equity would go from 33% to 30%, and non-U.S. equity from 22 to 20. That would be the 5%. So that represents the public equity, and then the other 5% would go to the private equity. I included slides 11 and 12, which is a different look based on the new performance reporting, just so as you go into your search for other providers. So this chart on page 11 shows in this inner circle, this inner donut, what the equity allocation is. So you see 52% to equity. This is your public equity. And then your alternatives, which is your private equity, is 8.5%. So basically we're running a 60-40 portfolio with some of it in private equity. And then the real estate, we consider a risk reducing asset class. So, combining that with fixed income, which is 33%, and the real estate 5.7, kind of gets you your 40% allocation to risk mitigating. And we include real estate as a diversifying asset class, or more akin to dampen your volatility, because over half of the real estate gains over long periods of time come from income. So we think that's more akin to, a diversifying asset class as far as, instead of a growth asset class like your public or private equity, or even high yield for that matter. So it just gives you a look of the breakdown of your asset allocation. Not too different from page 10, but you could see it in a chart fashion. And then page 12, again, in this inner donut, you see the index versus active. So for the most part, we have all our equities, public equities and public fixed income is indexed, and just the private equity and the private real estate would fall into that active bucket. And then just sticking with the performance report for the pension plan, I'll skip to page 15, just so you can kind of see the context of the private equity. So on the fiscal year to date or 1 year return. So here's the time weighted return for all of your private equity investments. I'll just focus on the 1 year return, that 5.38%. And the private equity policy benchmark is the Russell 3000. Think of it kind of as all cap plus 3%. So given how well the public equity markets did last year, that's why you see that big the divergence, and that explains the relative underperformance just on the short term. But longer periods of time, as Ken and others noted, your private equity and your private real estate have outperformed their benchmarks and been additive to the overall performance. Any questions on the pension plan? All right, so let's look quickly on the OPEB.
Brian, just one quick question.
Yeah.
Moving forward, would you recommend that we use that same benchmark for private equity, the Russell 2000 plus 300 bips, or is there something else that we can move to that may just track it more eloquently?
Yeah, it's a valid question. So it's maybe sometime you revisit down the road. So HarborVest, because their fund is a global fund that's both U.S. and non-U.S. holdings, mostly U.S., they use or compare their performance to a global benchmark. So they use the index they use is the MSCI All Country World Index. So that is more indicative of the global nature of their fund. So that's how HarborVest would recommend and does for their clients benchmark their performance. Now, some of the legacy private equity is all, well, I think it's predominantly US based, right? So the Lexington, the Mesereau. So it kind of made sense to use, or for as long as we did, a US based benchmark. The alpha target that was probably 300 over. I think different providers use different targets. I've seen people use 250 basis points over, 350. So over time, I don't know. I think you might want to, it depends what you do with the private equity program. But if the legacy private equity investments go out and the HarborVest becomes a bigger part of the portfolio, maybe switching to a different benchmark would make sense. Does that help, Eric?
Yes, thank you.
Yeah.
Are there benchmarks that just do private equity within subsectors?
There are benchmarks, that are developed by some other consulting. So, the one that comes to mind is Cambridge is a big consultant that is known and has tracked alternatives for a long period of time. And so there is a Cambridge private equity benchmark. But what you want to make sure is it is apples to apples. What we're getting with the HarborVest fund is exposure to all different segments of the private equity market: primary investments, secondary investments, and co-investments. So there are other benchmarks, Eric, that could be looked at from like a peer standpoint. And because the HarborVest program really hasn't gotten to maturity, we didn't start introducing any of those into this report.
Right, on that note, I think Common Fund also has a index of some sort. I'm not sure what exactly it covers, but is that relevant?
It could be. I know Common Fund has a big alternatives program as well. I haven't seen their benchmark as much, and where I don't know where you can pull that data from, but that could be a relevant one as well, Tom.
I think they had it for universities.
What was that?
I think they had it for universities. There was some kind of university index that I thought was alts focused.
Yeah, I think you're right. I think there's a NACUBO universe.
Yes.
That looks like endowment and foundations, and maybe that common fund or that Cambridge is in that NACUBO report, which is all endowments and foundations predominantly.
Yep.
And I mean, this goes without saying, I'm diverging for just a moment, but all through this process, at any time, anyone can reach out to me about any questions about the portfolio, others that you're coming up against, or maybe questions through the OCIO search. Reach out to me, email me with any kind of questions you have. So I'll take us to page 17 then, and this will be brief. This is the OPEB plan. Just recalling that it's slightly different asset allocation. And I know this was something that we were going to look with the investment policy committee, and I'll come to that. But the OPEB plan is roughly a 70-30 portfolio, 70% equities, 30% fixed income. The private equity is a much smaller allocation because we didn't have any of the legacy private equity here. So you see it's only 2.72% of the portfolio right now, but a much larger allocation, 10% target to private real estate, whereas the pension's only 5%. So that explains, but the biggest driver of difference between the pension and the OPEB is really that equity exposure. So you see on a one-year return, a 15.14% absolute. Again, I know you may not have it up, but the pension was 12.59. So, almost 300 basis points higher given the strong equity markets.
Yeah, no private equity to pull it down.
Right. Yeah, there's no meaningful results from the HarborVest vintages yet. All right.
Hey, Brian, just, hey, while I'm looking at it, just because I have the pages here back to back,
Yeah.
if you could ask your team to add in on the Town of Fairfield pension page, you have the list of all of the privates.
Yes.
It's missing the HarborVest 2023 vintage.
And I have that. So I'll send it. I wanted to get that performance report out to you yesterday.
Yeah.
And they were
But it's
delayed in
missing
that.
Yeah, it's just not on the list.
Yeah, so I have this
16.
page 16 already with the 2023 fund on there. So I could send it to you all this
Okay.
evening. I can reply to Gabrielle's email.
Okay.
Okay. So the fee analysis on page 25 is a little bit simple, and I say simple only because it doesn't include the privates, which immediately get a little bit more complicated because there's a flat fee and there's a performance-based fee. But just for the private, the public part of your portfolio, I wanted to show. And as Barclay mentioned, there's two components. So the investment management fee, this is the fee that is being paid to Vanguard on an annual basis of $165,000. Okay, that comes out of the trust. Like, think of that as a hard dollar that comes out. Now, on an asset-weighted basis for your portfolio, looking just at the equity and the fixed income exposure, which is a majority, 85% of the portfolio, on a weighted average basis, it's only 4 basis points because of how low these expense ratios are for the funds. So you're getting broad exposure to all these asset classes for just 4 basis points, which equates to $195,000. Now, that's just to give you an all-in fee, but it's just important to know that the $195,000 is not a fee that the town pays out of the trust. Any mutual fund expenses come out of the performance of that actual fund. That's why it's always important to have low fees. And that's why our index funds track so closely to their benchmark. So, we show it, and Barclay will probably show it like an all-in, but realize this 165 is just what's like more of a out of pocket. And the 195 or the 4 basis points, of course, is extremely important to how the performance is over time. Lower the cost, the more returns the town and the retirees keep. But just wanted to explain that breakout.
Oh, that's great to see.
Any questions on that?
What
Okay.
about custodian fees? Like, I know it's not broken out here, and it wasn't
Yeah.
brought up. That's another layer that's down at the investment level, probably.
It is another layer. I don't know what those are, Eric. Those are paid to Wilmington Trust. So Wilmington Trust used to be People's, right? You know, is the custodian. I think I don't know, I can't recall if I think they do pension payroll too. So yes, those are other fees for the trust, but I don't have those. More than likely, when you choose another OCIO provider, that you can keep custody there, but maybe so often you want to pulse the market and see what the fees are on other custodians, like US Bank, State Street are some big ones that come to mind. But it's a good point, Eric. Okay, on page 27 and 28, I often include this, so I just want to keep this updated because it's important as it relates to your asset allocation and talking about like a bespoke asset allocation for you. So here are the policy targets, and here on page 27, I'm reflecting, that full future allocation of 10% to private equity and the corresponding lower allocations to US and non-US equity. So on a 30-year time horizon, which Milliman would use for your discount rate, looking out based on the asset class forecast that Vanguard has, any really OCI should be able to provide this, capital market assumptions for each of the asset classes, your 30-year expected return is 7.48%. So well above the 6.9% discount rate you have right now. I don't think that Milliman will kind of push you to increase the discount rate. We always really look at distribution when it comes to any kind of forecast, since it's so uncertain. And so you can see from the 25th to the 75th percentile, that 6.9% is in range. But given the much brighter outlook for fixed income returns, now that interest rates are higher, that is helping. And that's I would say that's definitely the biggest change in the asset class outlook over the last 10 years, is really now we can get return from fixed income markets, whereas before this Fed rate hike cycle, you all know that rates were down to 0% and you just couldn't get much from fixed income. So that's the single best change that in our minds from an asset allocation perspective, the higher returns coming from fixed income. That kind of brings me to the next page, which is the same outlook, but looking for the OPEB plan. So because it's a higher allocation to equities, you can get our expected return for the OPEB plan is 7.88%. So probably something that, I would have discussed with the committee or the subcommittee is, it could be an opportune time to reduce the risk in the OPEB plan, or change the discount rate for the OPEB plan, because right now they're both 6.9%, but it's a much higher discount, expected discount rate for the OPEB given the asset allocation. So that's probably like one of the biggest topics I would have thought about coming into 2024 of discussing is the asset allocation for the OPEB plan. Do we bring them more in line and mirror the OPEB to the pension plan, or do we stay more aggressive with the OPEB plan, but maybe then there's a different discount rate? So it's just more of an open question, but I wanted to bring it up.
It's an excellent question. And it's one we should probably bring up for further discussion at the March meeting. In the March meeting, hopefully we'll have the actuarial discussion. We should have the actuarial reports, and we should probably bring up the discussion of having an experience study, because it's been several years since we've done a live experience study, and kind of how that might affect the numbers as well.
Yep.
Right. And get all of the information we can, especially since we have the numbers you're putting out here kind of are so bright.
Right.
We should probably have all of that information together for the March meeting.
What questions do you have for me just on the overall portfolio, asset allocation, markets? I did include some outlook slides in the last section. Maybe there's just one to touch on, but you know, that's less important than how the current portfolio is structured. What questions do you have for me?
How are you feeling, by the way?
Yeah, I'm sorry I'm not there. I did last night. I kind of spiked a fever. I thought I woke up, it was the same way. I'm like, not smart to get on a train and sit in a room with you all. So sorry I can't be there, but feeling a little bit better, but need some more sleep.
Need some more sleep.
Thanks for asking.
No?
Um,
Brian, I think this was really comprehensive. Really good.
Okay.
Thank you.
Yeah.
Really good. Exciting stuff.
Yeah,
Thank you
let
for
me just leave you one last thing, just forward looking on page 33 is this is our outlook for each of like asset classes and sub asset classes as far as, you know, do we think the asset class is undervalued, fairly valued, or stretched? And really the one that jumps out to us is US equities, given how well they've done. That's the one that looks most stretched to us from from a valuation standpoint. So you never know, the economists never get it, perfectly right in the short term, but eventually the high valuations may catch up to the US market at some point.
All right, I have a quick question for you. I'm just wondering what your economists are backing away from their recession forecast. It looks like your forecast numbers look pretty bullish.
Yeah, as far as their outlook is, they don't see a soft landing. That's the common belief. I think, that's the consensus belief out there right now is that there'll be a soft landing, which means kind of like the Fed's going to engineer things just perfectly so no recession happens. And in their view, that's extremely hard to get right. Is not cutting too much versus cutting too fast. So the kind of recession has just been delayed. Like, coming into the year, we thought recession would have happened like late last year. That didn't happen, given the strong sense of the consumer's just been in great shape. But they still see recession, call middle, second half of the year, but mild. They just don't see a soft landing, as the market calls it, or no recession. It's just very, very hard to get that perfectly right. So by the end of the year, I think they're pricing in, or our team believes there'll be 175 to 200 basis points in cuts by the Fed, but those won't happen until the end of the year. So that's our view as far as on rates or recession.
Thank you.
Mm-hmm.
All right, guys. Thanks. Ready to move on? Thanks, Brian.
Thanks, Brian.
Get some rest, take some Advil.
Yeah,
Yep.
thank you very much. Yeah, hope to see you at the next meeting.
Thanks, yeah.
Bye.
All right, guys, moving on. I just have some updates, some old business updates here. Item number, that'd be number 5, I guess. It's here, but it's here 6, but it's number 5. Just quickly on the Milliman, I got kind of an update on the admin side. The target is to go live in May. The update on that is that it's going quite well. This year's valuation data for the town's pension was pulled from the Milliman Mark system, which has been receiving ongoing data files from the town's Munis system, and the data appears to be in good order, and the valuation's nearly complete.
I think what the original target was July, wasn't it? So they had a schedule?
Given us July, they had hoped to be able to pull that forward to April, right? Because they thought they were making great progress, so they've dialed that back, tempered that back to May. But yes, I mean, they had given us that target of July. Yeah, so they're quite happy. The outstanding items still to do, there's one final plan document that is sitting with Shipman and Goodwin, the law firm that they've been working with. And then there's a technical question on school secretaries and the legal definition of highest salary.
Yes, I was actually, that was an issue I brought up the last, or did I bring that? All right, talk to you about it, because I think it was just,
Yes.
was some concern about a retiree and the wording of that and what the expectations were and stuff like that, so.
And,
It actually came up today with one of our members too.
huh, okay,
Because I think there was, in some contracts, it's last salary and then the highest salary was highest salary paid. So some people got a bump on July 1, they retired on that day or day after, they were never paid that salary.
oh,
So that was the question. It was like, so they said, a lot of people said, I'm gonna retire July 2nd because that's when I've got my increase. And they were saying, the town was kind of fighting back saying, you were never paid that salary, even though it was, and that was kind of that.
so what she says here is the union contract
Yeah, it says,
for the school secretaries
Yeah.
defines highest salary as the highest final base salary paid
paid, not,
to a
not,
member.
not kind of,
The language in the contract binding agreements is.
not very clear as mud. So, we had I had some concerns, some members had come to me and, our HR department tried to work it out and it didn't come to satisfaction. And I, pushed them back to their union. I said, your lawyers really have to get involved and figure this out.
Yes.
So we had a similar situation also today, and I was working with Megan through it. And our language is not paid, but it's obtained,
Right.
and it's in conflict with what the town charter says.
Ooh.
The town charter is very specific. So I was kind of surprised that this language, the CBA would be the one that you'd kind of go to. But if you look at the original standing plan document and then you look at the town charter, they both read very differently.
Huh,
So I'm kind of figuring out how these divergent principles were taken.
And
But
I know what I was saying. And I think part of it was, I don't want to say maybe the informality was that, that now we've got better people, maybe looking at the numbers and interpreting it better. So it was, people were saying, we would call the town hall and they would say, we would tell them what the last salary was and that's what they would take and go with it. And now I think people kind of maybe make it a little more,
setting the rules here.
the rules are,
Rhythm that's gonna be in a data set. Yeah.
And then it turned out that there may have been some decision point that was made a couple of years ago between HR and Millman and the actuary. That nobody was really, that this board was not included in on. So I think that there needs to be a little transparency on those
agree.
emails and kind of find out how that decision was made and who made that decision and who decided to take that track.
yeah. I did, again, and I'd like to clear it going forward, but in this one individual case, and I don't want to talk in an individual
Yeah.
basis, but it was just in the sense that why would this person be penalized when the practice was X and now, until it's more formal, so.
Okay. Well, it would be, so where did you leave it with?
I'm still in the research phase.
Okay. Okay, well, let's find that out. I mean, where you find those points of conflict, right? We gotta keep a list of that, so that way we can, put that forward should the, so that they can be.
We have two members that are presently in the town's pension plan. It's a very odd situation.
Okay.
In the town's pension plan.
Which is not technically closed.
Oh,
Two members of your fire department?
Really?
That were,
So we had two members that were part of another bargaining unit. And they moved into our bargaining unit, and when they came over, their language came over from the public works contract.
Huh.
It happened over 10 years ago.
I was gonna ask you how long ago.
Over 10 years ago.
Still kind of recent.
Yeah.
So.
is there, I don't know, I mean, there's gotta be, I'm pretty sure there's,
So the,
does there exist some type of a group that kind of, works to
Well,
determine the remedy?
we're working on that now, I think. I didn't know that it impacted other bargaining units, but it seems like everyone's got this rub point now. Because like I said, it sounds like this decision point was made a couple of years ago under
Right.
the last administration. We're just kind of working through it.
Learning about it.
Yeah.
Right,
Yeah, it's kind of got uncovered recently, so.
right, yeah. Okay, yeah, and that's the thing, when you go to these, when you're going to an administrative system, that it's all uploaded into a database and you're setting it,
got it.
right?
Listen,
We're gonna find out, okay, we're gonna follow these rules, right? We're gonna follow the rules.
What rules? Yeah, they're looking at conflicting rules. Wait, are there rules? Yeah, right.
Which rules?
Which rules?
Rules.
If I could,
Different.
this is the risk of having parallel documents. It's an extreme.
No, it's a good point.
Extreme case, but with the Constitution versus the IPS. Milder, probably, but it's the same risk. One saying one thing and the other saying something almost the same, but not quite.
And we'll have to make sure that it's clearly noted
Right.
that, this is,
IPS is probably the governing
you
document.
go to the
Yes,
governing,
yes.
it's gonna have to be clear, this is clearly the governing.
Source
document.
of truth, as they say.
Right, I mean, there's the PowerPoint and
Right.
then there's the document, right? It's the
Good
PowerPoint,
example.
Right.
the document.
Yes.
Right, wow, okay, well, so it sounds like these are, okay,
Yeah, hopefully it'll work out. I mean,
super fun stuff, guys.
yeah, well, I mean, it's on the, whatever. I mean, you guys done a lot of work, but I was just, well, it was like, who are you calling me? What's going on? So then the people, unfortunately, not everyone wanted to get super involved, so I had to facilitate some people talking.
Okay, all right. What's the temperament of this group to, in March, change the allocations around while we go out into a search for an OCIO? Do we wait to do that, or do we, we put that into discuss in March?
I would
I
probably
put that
suggest I would suggest we freeze.
Yeah.
I think we freeze, right? My inclination kind of is we just hold, we freeze, we change nothing, right? And we just go through the search.
New OCIO could be one direction, the other.
I know
I
what,
mean, there's nothing
okay.
that would make us, we need to make a change in
I
that.
don't know if we need to make any changes here. We just ride through, we move the accounts. Okay, perfect. Thank you. All right.
Although Vanguard is saying the equity markets are basically going to collapse.
You're right.
Other than that,
I couldn't believe that. I was like, wow.
that's strong.
Okay, great. And again, on other old business, any other business, new business, old business, Bill, anything going on in your world?
No, not that pertains to this. There's plenty going on.
What are you going on in your world?
Court cases, monopole.
Kaylin, anything?
Question, was it brought up regarding OPEB payments coming out of the trust at some point?
Oh, we have not yet talked about
No.
distributions out of OPEB. No, so I don't think that's a decision for this board.
Okay.
I don't think we turn that light on. I think that's a Board of Finance and that's a Board of Selectmen and a First Selectmen's
I
office.
wasn't sure if there was a plan document that kind of outlined, because I know you guys have this mandatory discretionary piece and the fees that come out of. And I wasn't sure if that was in violation of any document that was already kind of out there. Is there an OPEB plan document? Okay.
There's contract language,
Is it for both trusts or is it only for police and fire or is it?
both trusts,
Okay.
documents for both trusts.
Do you
Well,
know?
police fire was the original OPEB trust and the town was developed later on. I don't know what the town's OPEB trust looks like.
The town was 09. I think they were both established at the
It
same,
may have been. I know that ours is specifically to us,
your document.
our document, yeah.
Do you know, because you know that document probably a little bit, so right now, as you guys know, all of the payments are coming out of the town cash and then we're kind of truing up. And it's kind of a logistic. It's hard to explain it to somebody. So the thought process was, can we treat it like pension, that the employer contributions go over, any employee contributions go over, and then have the payments from Anthem or whoever the provider is pulled directly out of the trust?
Yeah, so when we talked about that last time, we talked about the cash flow reports that were not showing the employees' contributions going into the OPEB trusts.
Once a year, right? It was like
Yeah,
volunteer contribution.
yeah,
And then we said that, that money should go in
as it comes
as
in.
it comes out, because it should go
Yeah.
into investments. It shouldn't be used as just paying out of the cash fund. And then we have an agreement where there's a savings and a checking account, right? That the savings account is where our contributions would go and grow. And then the checking account would be the part the town would be putting into, where you put your paycheck into, where the trust insurance payments get paid out of. So that language is very clear. There's CBA language that delineates that in our contract. I think there.
Yours is the only one.
This is the only one, yeah,
Yeah.
it was, yeah, so.
So that's something to.
It has to do with, it has to do with members and when they retired.
Okay.
And certain members come out of the checking account.
Yes.
Certain members come out of the savings.
So my hope was, and Ken had to drop off because he's with his parents down in Florida. My hope was that with bringing him back onto the board, that would be a really great project for him to do. Because my plate is full, projects here. And that he could help figure out the cash, the movement of cash. But that's separate and distinct from, is there language in that contract that prevents or allows or speaks to when the OPEB fund grows to a size that it can begin to make distributions out of the fund? Because now that we're at $80 million, have we hit a size of that fund where it could begin to you could begin to have distributions out of it?
See, our language in our contract, I believe, says, let's say after date X. Okay?
Date, not size.
When you retire, those members that retired after a certain date, those members can come out of the savings account. And then the others, can come out of the checking account.
So it's a vintage.
For us, it is. It's a vintage, but only because the members who put into it, that's why.
Oh, okay, so we can have the,
CBA's.
so perhaps it's the actuaries that are gonna have to, if it's a vintage, then it's the actuaries will have to determine who would qualify to receive, who could be paid, for whom those
Dealing with
those
groups within Anthem to say, okay, these
could
can
be paid out of those.
But it's a little complicated.
It's a mapping.
A lot more
It
complicated.
could be a Milliman, but Milliman could map that once everything else is mapped, or, right, because they'll have tracked everybody.
A separate group.
It's a group.
Separate group for health
Right.
insurance. We have multiple groups.
And is that fixed though now, Eric? Because I mean, is that like the group that's, I forget, no one's changing buckets
No.
anymore. It's not said like going forward, it's done. Okay.
Yeah, it had to do with an increased contribution in OPEB trust contributions by the bargaining unit. That's why that was established.
Okay. That's,
So it was something that we were
so maybe we come back to it,
July, but hey, with everything else going on, I don't know.
maybe we come back to it once Milliman is live. Right, and you have all of the data up, because it sounds, and the big question you kind of ask Milliman. Because you'd have all of that data would be in,
Milliman's only doing pension right now, correct?
Thought they were doing everything, but.
Are they doing OPEB as well?
but they're also pension recipients too, right? If they're pension, they're also OPEB. They're both, if they're at an age, right? So you would be able to tag them.
Yeah, though, I mean, those are mostly,
They are.
yeah, retiree as
Know who they are.
Right now, I don't want to say it's easy because we can pull out a pension checks and bring it over to the OPEB trust because it's all within M&T as well. So there's just it's really the Anthem payments coming out of the trust.
Okay, well. Okay, that's, but it's a nice, if there's no, that would be a nice source of cash, right? To make those, to make. So
Yeah,
fund.
right now, it's coming out of us and then we're doing a due to because it's
Yeah.
running through the balance sheet of the trust and the reporting is such that it looks like there's nothing coming out, but there really is stuff coming out, but not the cash itself and.
Okay.
What percent is OPEB?
So we might be 55 now, 50, 55. I mean, we haven't seen this valuation report. It hasn't come out. We only get that funded report once a year.
Or the CAFA, the last CAFA would have the funding rate.
But I don't have but do we have it would have
At the current,
been,
right, at the current year.
Yeah,
But
so-
last year, what would you see that is?
yeah, I think it was around 50, a little more than 50%. Yeah, but it was really aided by that one performance year we had,
One year, yeah, that-
33% performance
that
year. That was like, boom, you're low OPEB.
But then we had a correction.
A little correction and yeah.
We were looking at low insurance costs too.
Mhm.
Very flat. Very flat.
So, yes.
So I guess at one point, came up that I guess employee contributions weren't being made on a timely basis.
Well, pension goes in probably every quarter.
Employees, so employee
Correct.
has certain.
But active.
Active.
Yeah, current.
Yeah, and there's not that many groups who
Right.
to
All right.
Every medical that are active. It's a fire. I don't even know if it's police. It might be. Nurses used to, but now they don't anymore. They're not actually going in. they're getting reported, it's revenue source, but again, because the expenses aren't coming out, it's and the employer share isn't going in because the cash is being used from the town. So every month it's getting dwindled by the expenses coming out, but it never physically goes in. It never goes in until we true up the next year.
Okay.
It's being reported, it's income, as is the employer piece, because there's no cash coming out. All the cash is coming out of the town, so that's why it's a complicated thing. So I'd like to, like I do with pension, I
Cash.
put all the employer share over there early and then quarterly or so, and then the piece goes over.
Yeah, well, let's get Milliman up and running. Go through this.
So on the pension,
Guys, can we get we should probably let this go. Can we have a motion to adjourn?
Motion to adjourn.
All right, there we go. Thank you. I'm gonna make sure you say.
Right, guys.
Hey.
Good night, guys. Thank you.
Some money comes out.
Right.